with this rate rise, what does that actually mean for current mortgage holders and borrowers?
Well, we'll see here that there's 800,000 loans which are going to come off fixed rate between now and the end of the year. And this has come from the Reserve Bank. So most of these borrowers have borrowed at somewhere around the 2%, 1.99 to 2.29. Their rates, when they come off fixed, are going to go to around 6%. And when the banks assess whether they can afford the loan, APRA are using a buffer of 3%. That used to be 2.5. So we've exceeded that 3%, and most people who are coming off fixed rates probably can't theoretically afford their loan. So we have a real problem. There's lots of mortgage stress that's going to hit between now and Christmas this year.
And one of the solutions proposed to that, Roy, is to just use your savings to pay off those new increases. Well, CommSec confirming that that's not going to be possible either for most households, because household savings are now at a 5.5-year low. Boy, wasn't that quick, Roy. It wasn't that long ago on this show that we were talking about record household savings, as you can see there in 2020, which I think talks to the longevity of this show, I might add. But, suddenly here we are with 5.5-year lows on household saving, which is really concerning.
Which means that people are going to start spending less because we've got less spending, which means inflation should come off the boil a bit. And I'll give you two life examples. I called an Uber this week and it was 5:30 in the evening, and the Uber driver said he normally works through till 9:30. I said, what about tonight? He said, I'm knocking off now, 5:30, because there's no work for him. I've got a pizza shop client, not selling any pizzas during the day and a lot less than normal in the evenings. He's gone out and got a part-time job during the day so he can just keep his pizza shop open at night. So I know they're only two examples, but on the street, people are hurting.